I just want to address a fundamental issue, which I'm often asked about. Why is it that Greece got into such a mess? Why is it that Ireland got in such a mess? Now, although there are many, many broader issues that have been impacting these countries to do with the global downturn, here is a fundamental truth. These countries, all these countries that are within the Eurozone, by definition, they have the same currency. By definition, the costs of borrowing are therefore largely the same because they are fixed or linked to the rate that's set by the European Central Bank. By definition, then, the fundamental lever by which most people drive national economies in terms of winding down demand at time of inflation or pumping it up at time of recession have disappeared because it is impossible for an individual country within the euro to increase or decrease its interest rates. And because of that issue, when you have an overheating economy, as we had in Ireland and in Greece, with high inflation, where interest rates were much lower than they ought to have been in that country for the personal interest of that particular nation, then there was very little that could be done about it. And when a country goes into recession, as also happened, or is on the edge of recession, as happened in Germany recently, again, they could find they have an average interest rate set by the European Central Bank, which is the midway between what the high rates which Greece and Ireland really needed and the much lower rates that people like Germany needed. That's a great challenge in terms of the management of these economies. It's an unsolved problem that the euro will face, as it has very different kinds of economies all strapped together into the same boat.